All right. Well, once again, welcome everyone to this Save Plan webinar. My name is Samuel Janietz. I am a Senior Policy Analyst here at NEA in the Department of Education Policy and Implementation Center, or EPIC, and I focus on higher education and workforce issues. And with that said, I want to pass the mic over to my colleague, Matt, who will introduce himself.
Thanks, Sam. Hello, everyone. Thanks for joining us tonight. My name is Matt Rawson. I am a law fellow in the Office of General Counsel here at NEA. I look forward to answering your questions, and I will pass it to our colleague, Scott.
Hello, my name is Scott Kish. I'm with NEA Member Benefits, and I have been working with the NEA for the last several years on our Student Debt Navigator, the tool that we help build to help folks figure out sort of how to take care of their student loans. So look forward to sort of walking you through this and linking you to that program as well.
Great. Well, I appreciate all that. We're ready to get started. Matt, are you able to see the Save Plan on the screen right now?
Yes, Sam. Looks good.
Great. Perfect. So I wanted to just get started by telling you a little bit about some of the resources that are available to you. To get the latest news, webinar invites, and resources, all you have to do is to text student debt to 48744. All of the resources will be available at nea.org/student-debt. So the work of NEA and the work that we are doing here on behalf of our members actually get some of these policies implemented to support you all. So when it came to the Public Service Loan Forgiveness Program, hearing from our members, we advocated for that. When it came to income-driven repayment programs, we have advocated for that as well. And so the power to have these changes really comes from hearing that influence. So we encourage you, even if you're not a member, to sign up to that text student debt to 48744 or check out our resources. And if you are not already a member, there are ways to become one as well. So with that said, we'll get started. So over this webinar, we're going to cover just a few things. We're going to talk about the state of income-driven repayment program and how we got here. We're going to tell you a little bit about the SAVE plan, which is the most affordable student debt income-driven repayment plan ever. We'll tell you a little bit of information and give you instructions on how to enroll in SAVE. And then we will answer some of the questions that might come in. And I believe tonight it might be a short list. So how did we get here? So the issue and the idea of tying someone's loan payments to their income is not a new idea. It goes back, 30 years at least. When in 1993, income contingent repayment, or ICR, became available when the direct loan program was available. Now in 2010, President Obama signed the College Cost Reduction Act, which created IBR, or income-based repayment. Now these, even though they have very similar names and titles, were different programs. And even though they helped many people, at the same time, it wasn't necessarily enough to help those on a day-to-day basis have a sustainable debt repayment. So in 2012, the Pay-As-You-Earn program was created using authority from that 1993 law that created ICR. In 2015, it became the revised Pay-As-You-Earn program. And current borrowers may have been enrolled in any of those in the past. Now, some of these you may not be able to sign up for in the future, but they are still basically grandfathered in. So you might have someone from 30 years ago, 25 years ago that was in an income contingent repayment or income-based repayment program and might still be paying that off, because unless they changed or they had consolidated and gone into a different program, those remained active. So that brings us to today, or I should say last year and going into today. The Biden administration launched the most affordable IDR plan ever, which is called the Saving on a Valuable Education, or SAVE plan. So it ties your income, or your monthly payment to your income at that time, based on your income and family size. And this was really a monumental thing that the Biden administration did, because it's pretty groundbreaking in that it provides the lowest monthly payments of any IDR plan available to nearly all student borrowers. Not only that, but it also stacks with the Public Service Loan Forgiveness Program, the PSLF program. So you can be enrolled in both the PSLF program, and you need to have an IDR, be on an IDR program as well, and that will stack. So for instance, even if you're on an IDR plan that normally might take 20 years to pay off, if you are enrolled in the Public Service Loan Forgiveness Program, after 10 years, after qualifying 10 years of payments, that amount would be wiped. So it does stack. You get that idea of a lower monthly payment as well as the forgiveness aspect. So let's talk about the SAVE plan specifically. Like what does it do? Why is it special? This might get a little wonky, so I apologize for that, but I think the end result is something that everyone can appreciate. So what it would do, it will decrease the monthly payments for most people by increasing the amount of income that is protected from the calculations. So similar to adjusted gross income with taxes, if you are able to raise the amount that is excluded, then you're basing the calculations on a lower amount anyway. So here's an example. If you are a single borrower earning $32,800 or less, or if you're a family of four earning $67,500 or less, which is 225% of the federal poverty limit, you will pay nothing per month. And all of those $0 monthly payments still count towards eventual forgiveness under the income-driven repayment program. Now, borrowers earning more than that still will save average of at least $1,000 a year in terms of payments. Now, one of the biggest things, in my opinion, that the SAVE plan does that helps not only in terms of your pocketbook, but also your own mental health, is the idea of having extra interest accrual that is past your monthly payment wiped out by the government. So many borrowers that are on monthly payments before SAVE might pay their loans every single month and still see their total debt amount go up, because the added interest over that month would accrue and accrue. And so the total amounts that they owed would be higher than what they originally took out. Now, that can be extremely frustrating and demoralizing, that you're trying to be a part of the system, trying to pay it off, and still have that situation. So what the SAVE plan does, as long as you make your whatever monthly payment you are supposed to make, if there is any extra interest accrual that is wiped out, the federal government takes care of that. The principal balance will never increase if you make that monthly payment. And also, if you are a borrower, if you are a married borrower that is filing separately from your spouse's income is not included in that calculation. So for some people, that may mean that if you're filing separately, you may have a much lower payment than if you were filing together for taxes. So what has it done so far? So let's just give you an example. So to date, $1.2 billion of debt relief from SAVE have been instituted. And that includes from those borrowers that after enrolling in SAVE reached the point that their loans were discharged. We have 7.7 million borrowers now that are enrolled in the SAVE plan. We have more than half of that, 4.5 million, that are paying $0 a month. Just think about it. $0 a month compared to possibly hundreds of dollars a month. That makes a real difference. And to this date, we have 153,000 borrowers that have gotten forgiveness because of the SAVE plan. And this is only increasing. We had numbers last month that were a little lower than that. So we're really happy to see that the SAVE plan is recognized as helping many people and that more people are hearing about it. So here's just an example really quickly of some income levels and family sizes, what you could expect to pay. So as I said, about borrower who earns less than $32,805 a year or $67,500 for a family of four will have a $0 payment. As I said, other borrowers save more than $1,000. And that is something that I want to lead into by telling you about some other changes that will be coming. So SAVE was rolled out in kind of two phases. The first phase had that idea of a lower time to completion of the program and the lack of interest accrual. But starting in July, the full program will become active. And what that means is if you have undergraduate loan payments, you are going to be paying even less because the percentage of your discretionary income that is required is going to go from 10% to 5%. And as I said, there's that protected amount even before you even start the calculations. So what that means is less of your monthly earnings, of your total earnings, will be devoted to paying off loans. Now, if you have graduate loans, you will still see a decrease as well if you have a mixture of, if you have a mixture of undergraduate and graduate loans. That's going to be a weighted average of the combination of the two. But for those that just have undergraduate loans, you will see that percentage drop from 10% to 5%. If you have loans, or I should say after 10 years of payments, if you originally owed $12,000 or less, any remaining amount would be wiped out. That is it. So you can see that idea of borrowers with lower debt amounts being able to pay them off easier, especially because a higher percentage of those that actually end up defaulting are for a significantly smaller amount of debt total. It actually is around $12,000 or less. So this helps those that need it the most, as well as helping out everyone with a number of the provisions. So again, just kind of an example, as I said, we will be emailing this video out, so no need to kind of look through this super quickly, but just an example of some of the savings that one could make from the current benefits versus what will happen after July. So let's say you start with $130 you're paying a month. If you just have undergraduate loans, that might be $65 a month. If you have a mixture of graduate and undergraduate loans, that might be $108 a month. And if you just have graduate loans, that's going to be 10% of your income, discretionary income. But for most borrowers, this change after July will make a significant difference. Okay, I'm going to hand it over to my colleague, Matt.
Thanks, Sam. So now that we've covered the SAVE plan's tremendous impact, let's go over some eligibility concerns and how to get even more folks enrolled in SAVE. So two barriers that I'll highlight here. The first is default. So borrowers in default are not eligible for SAVE, but the good news is that you may be eligible and able to get out of default right away under the Fresh Start program. The Fresh Start program is free. It only takes about 10 minutes to sign up, and it allows those with direct loans, FFEL loans, or Perkins loans held by the Department of Education to get out of default immediately, among other financial benefits, in order to apply for an IDR plan. The second barrier that I'll mention is loan type. So not all loans are going to be eligible for SAVE. Some borrowers may need to consolidate their loans in order to be eligible. Luckily, like with the Fresh Start program, loan consolidation is a quick, free process through which you can refinance one or more federal loans into a direct consolidation loan with a single payment and fixed income rate. And on the next slide, we'll show you some different loan types. So as you can see here, subsidized and unsubsidized direct loans, direct plus loans made to students, and direct consolidation loans that did not repay Parent Plus loans will be eligible for the SAVE plan. Some FEL loans and federal Perkins loans will also be eligible if consolidated, but Parent Plus, private, and state-based loans, as well as loans in default, are not going to be eligible. So if you think you may be eligible, don't wait. Apply for and benefit from the SAVE plan today at studentaid.gov/IDR. I know Sam mentioned that some of the benefits won't take effect until the summer, but you can start benefiting now from other provisions already in effect. If you were enrolled in a repay plan or recently applied for it, you will be enrolled in the SAVE plan automatically, so you won't have to worry about an application. And the same is true if you are more than 75 days late on your payments and previously gave the Department of Education approval to access your federal tax information. You may be enrolled in the SAVE plan automatically by the department. I say may in that situation because the department will place you in the IDR that results in the lowest payment amount, which will likely be the SAVE plan, but there are some rare instances in which it would not be. So to apply, go to studentaid.gov and create a federal student aid ID. If you already have one, that's great. Just make sure your contact info is up to date. You should see a login portal similar to the one pictured here. Your ID will give you access to your student debt dashboard, which provides a wealth of historical information on your federal student loans and forgiveness opportunities, and will be a great resource for you moving forward. But keep in mind that your FSA ID is not the same as your login with your federal student loan servicer. So those are two different things. Good news is that the application is the same for all IDR plans. So if you've applied for an IDR before, it may seem familiar. Be prepared to submit proof of income, family size, marital status, and spousal income if you are filing a joint tax return. The application can take as few as 10 minutes once you've gathered all of that information and have it ready. And for your convenience, you can consent to the Department of Education pulling your federal tax information directly from the IRS and automatically filling in that portion of the application, which would save you a significant amount of time potentially. Once you have submitted your application, keep in mind that it may take a few weeks for it to be processed. And if you have questions or want to change your application in the meantime, feel free to contact your loan servicer. They should be able to help you. Once your enrollment is confirmed, you will receive a new billing statement from your loan servicer with your updated monthly payment amount. And after that, keep in mind you may want to enroll in auto pay through your servicer. In addition to preventing you from ever missing a payment, that will also give you the benefit of a 0.25% decrease in your interest rate. And also, one thing to keep in mind for later is that you will need to recertify your family size and income annually to remain eligible for SAVE. If you consented to the autofill feature through the IRS, the Department of Education will automatically recertify you. If you did not consent to that, that's okay. The department will just send you a recertification reminder to help you. That way, you won't become ineligible for that reason. So now, before we finish up tonight, there's one other thing that we were hoping to mention. This might apply to, well, this will apply to folks in SAVE, but also in other IDR plans and public service loan forgiveness as well. This is the one-time account adjustment. So in order to address historical failures in the administration of student loans, the Biden administration is helping more borrowers get closer to forgiveness by automatically reviewing their payment history and counting more payments as qualifying payments. So this one-time account adjustment will count more time towards IDR and public service loan forgiveness. And that might include late and partial payments, payments made under any repayment plan, payments made on Parent Plus, FEL, or Perkins loans before consolidation, or months spent in extended forbearance, 12 plus months consecutive, or 36 plus months total. So the timeline for this will depend on the loans that you're holding. So direct loan and federally held FFEL holders will see the adjustment occur automatically in 2024 if it has not already happened for them. Commercially held FFEL, Perkins, or Parent Plus holders, they will need to apply for a direct loan consolidation prior to April 30th, 2024. So that's an important deadline coming up. Once consolidation is complete, their payment count will be temporarily reduced to zero. So we just want to let you know in advance, because it could certainly be concerning. But after the account adjustment takes effect, your payment count will increase based on the adjustment. And we want to mention that before that deadline passes, before the April 30th, 2024 deadline for the account adjustment passes, we will host another webinar and have more resources to share. So please stay tuned for that. We can advance next slide. For other resources, to the latest news, other webinar invites, and updates from us, please text student debt to 48744. You can also access our resources at nea.org/studentdebt. And if you are not already a member of NEA, we hope you will consider joining us. Our ability to create change comes from the strength of our members. So please head to nea.org/join to learn more. And now we will answer some frequently asked questions in the hopes that that will help as many people as possible. And I will ask Sam the first one. So Sam, how do I know that I am enrolled in the SAVE plan?
That's a great question. So most borrowers that have applied for the plan can see that reflected on their next billing statement. If you were previously a part of the Repay plan, you already were automatically put into SAVE. And at this point, you should have seen that on billing statements. That was probably done at some point late last year. On the other hand, if you just signed up for IDR for the SAVE plan, your servicer account might not have reflected that immediately. Sometimes it takes a few months for that servicer to process it. But you can always go to your account dashboard at studentaid.gov to see what the federal government has you listed under, which for that purpose is probably the most accurate and the most important to see. So if your servicer doesn't have you updated, definitely check out studentaid.gov. So the next question, I'm going to throw back to Matt. Matt, why is my estimated payment higher under the SAVE plan than my previous IDR plan?
Yeah, so it's an interesting question. This is a really unlikely scenario, but it may happen, and it would be explained by an increase in your income or a reduction in your family size, since those are the key metrics for the plan's payments. And that if that happened since your last certification. In any event, keep in mind that the estimated payment you see when you apply for an IDR plan is not final. Your accurate payment amount will be on your next statement. And for some with higher income, the standard repayment may be a lower monthly payment amount, so that's possible. But either way, for more information, please feel free to consult Federal Student Aid's Loan Simulator. If you go there, you will be able to compare some options, see what the different IDRs might mean for you. And so, Sam, back to you. Will signing up for SAVE take long?
I have a great one-word response for this, and that's no, it will not take long. It can just take a few minutes, and you can use any device. You can use a cell phone, a tablet, a computer, a laptop, desktop. It doesn't matter. It's the same process, and it's something that can be done in just a few minutes. Now, I have two great examples of just in the last few weeks where this was done. At one of our conferences, we were meeting with some of our members and found out that they might have not known about SAVE, or they had some questions. So on the spot, we assisted them to sign up. And in one case, we had someone that in less than 5 minutes realized they were saving like $600 a month on their monthly payment. In another case, we found out someone was saving like $400 a month. And again, this took literally 5 minutes to do. So it does not take long, and that's one of the great things about SAVE. It's before, sometimes some of these processes to enroll were arduous or just took a lot of paperwork to get through. This is something that can be done super quickly. With that said, I will say if you choose not to auto-certify and choose not to allow the IRS to talk to federal student aid, you might need some information on your tax return or prior year tax returns. So we do recommend doing the auto-certification to simplify and speed the process. And once you do that, you won't actually need to recertify in future years because that's already in place for your tax information to already be communicated with FSA. Now, Matt, I heard about the Supreme Court decision last year. Was the SAVE plan affected by a Supreme Court decision?
So I have a similar one-word answer, which is no, it was not. The Supreme Court's 2023 decision in Biden v. Nebraska addressed broad student debt forgiveness of up to $20,000, but it was under the HEROES Act. And that's important because the Biden administration's SAVE plan in the ongoing negotiated rulemaking is intended to create regulations addressing debt forgiveness for specific borrowers based on the Higher Education Act of 1965. So as both a practical matter and a legal matter, they're two separate issues, and the SAVE IDR plan is not impacted by the court's decision last summer. So Sam, here's a technical question. Do Parent Plus loans qualify for SAVE?
So unfortunately, the answer is no. The Parent Plus loans are not eligible for the SAVE plan. This was something that was discussed during negotiated rulemaking and something that many borrower groups spoke out about. Unfortunately, the department did not go that direction, and Parent Plus loans do not qualify for SAVE. However, if you consolidate your Parent Plus loans into a direct consolidation loan, it is eligible for an income contingent repayment plan, so an ICR plan, but not SAVE. So some of the ICR provisions are not as generous as SAVE, but if you do consolidate into a direct consolidation loan, you will still be eligible for something that is linked to a percentage of income. Matt, we hear questions a lot about people with private loans or refinancing their loans with a private company. Are they eligible for SAVE?
So unfortunately, no. The federal government can only forgive debt that it holds. So that's the key here. So loans from banks or commercial lenders, student loans that originated from state government programs, refinance loans owned by a bank, a company like SoFi, for instance, a credit union or a student loan authority, will not be eligible for SAVE, PSLF, or the other federal debt relief programs.
Great. And, we are happy to take your questions. I don't think we will necessarily be getting a lot today right now, but feel free to put in that Q&A if you do have a question. I will say, once again, the SAVE plan was created with the intent to help the most amount of people that are experiencing the greatest financial hardship and in most need. It is a progressive system that, as you earn more, you still likely will have a lower monthly payment than before. But for many people, as I said, the average amount of student debt that people that end up defaulting on their loans is less than $12,000. So with this, that's money that people are then putting back into their pocket, able to spend that on necessities, able to start a business, raise a family. And so we are, once again, really happy to be talking about this on the SAVE Day of Action in conjunction with the Biden administration. And, as I mentioned, we will be pushing this out as well as some other details to you via email. I will also say you may also get an invite to a roundtable on Monday with NEA Vice President Moss, AFC President Randy Weingarten, and Domestic Policy Council Chair Neera Tandon to discuss the impact of SAVE on our members and on educators throughout the country. With that said, Scott or Matt, do either of you have any questions that you sometimes maybe hear from members, or any last thoughts?
Yeah, I mean, the only thing that we would just add is that, sometimes your student loan situation is complicated. And if it is, we do have what's called the NEA Student Debt Navigator, which is really a tool designed to help members get through some of these more complicated issues. The first year of service is complimentary to members for them to use and get all the help they need. And it's all accessible through the NEA Student Debt Hub that Sam shared earlier. So just click on that. And then you can actually have someone sort of hold your hand through the process if needed. So just want to mention that that usually comes up at some point along the way, but we love it. It's helped tens of thousands of members sort of get the service, the forgiveness that they have earned. So it's the only thing I wanted to mention.
Great. Well, once again, we appreciate you all joining tonight, and we will reach back out with this information. And once again, thank you for joining us. Hope you have a wonderful night.
Good night.